So welcome everyone again to our webinar today on interest limitation rules. It is my great pleasure to introduce our panel of experts for the webinar today. So first we have Sonia Howard. Sonia is a director in our financial services tax group and has 25 years experience advising on tax matters relating to funds and asset management. Next we have Yvonne Diamond. Yvonne is a corporate tax manager with over 10 years experience in practice. My name is Angela Fleming and I lead the financial services tax team in BDO, as well as BDO's tax library. First, let's start with a bit of background to these new rules. So in July 2013, the OECD issued an action plan on base erosion and profit shifting, or BEPS. The aim of BEPS was to modernise long-standing tax rules, which were considered, I suppose, not to have really kept pace with things like globalisation, technology, and the growing role of intangibles and services. BEPS had 15 separate action plans, and one of these was interest limitation rules. Separately then, the EU embarked on, I suppose, its own kind of BEPS-style action plan, and it passed two anti-tax avoidance directives, or ATAD for short. And as their name suggests, these directives also sought to tackle certain types of tax avoidance. So there's a fair bit of overlap between the BEPS action plans and the ATADs. And in some circumstances, the ATAD is really an acceleration of the implementation of some of these anti-tax avoidance measures. And interest limitation rules, I think, are a really good example of this. So in the BEPS action proposal on interest limitation rules, they didn't make the introduction of the rules mandatory, but the ATAD does. So in the EU, all countries are therefore required to introduce these new rules into their local legislation. In devising the Irish rules, the Department of Finance launched a number of public consultations, with the first of these in November 2018, and then that was followed by two further feedback statements in December 20 and July 21. And the purpose really of these was to engage with businesses and their advisors in the drafting process. So these rules are really complex, and what they were trying to do was iron out the complexity of the rules, but also to try to kind of address any potential unintended consequences that might arise and deal with those before the introduction of the legislation. So in BDO, we were involved in that consultation process, both through submitting formal written responses and also in some meetings with the Department of Finance. I think it's also worth pointing out at this stage that unlike some of the other measures, BEPS and ATAD, the interest limitation rules are not just aimed at these kind of huge multinational companies with hundreds of millions of dollars of turnover, but they actually have the potential to impact Irish SMEs and domestic companies also. So you don't just need to be transacting on a cross-border basis. So what are the new rules? At a very high level, these rules seek to limit the amount of interest that can be deducted for tax purposes to 30% of EBITDA. So that's your basic test. EBITDA being earnings before interest, tax, depreciation, and amortization. But like all good tax rules, the devil is in the detail, and the application of these rules is extremely complex. And it also includes a number of exemptions and relieving provisions as well. So I'm going to hand you over to Yvonne in a moment, and she's going to bring you through how the rules operate, some of the definitions and the new terminology introduced, and how the rules can be applied in group scenarios. Sonia then is going to discuss the various exemptions and relieving measures that are contained in the legislation. And the aim of our webinar today really is just to give you a very kind of high level overview of these rules so that you can better appreciate the impact, if any, that they're going to have on your business. We have left lots of time at the end for questions, so please feel free to use the Q&A function to submit any questions that you have. So without further ado, let me now hand you over to Yvonne.
Good afternoon, everyone. My name is Yvonne Diamond, and as Angela mentioned, I'm a corporate tax manager here in BDO. So what I would like to do today is take a somewhat practical look at how the new interest limitations will operate for a corporate taxpayer. So when we consider how the new rules will operate, there are a lot of new definitions and new key terms to consider. So first of all, let's take a look at what the legislation means by interest. So for interest limitation purposes, the definition of interest is not limited to just interest on a loan in the traditional sense. It has a wider meaning, and this meaning includes, for example, discounts where securities are issued at a discount, amounts under interest rate swaps or hedging arrangements directly connected with the raising of finance, the finance element of finance lease payments, the finance element of operating lease payments, but this is for trading lessors only, debt arrangement fees, profit or loss on financial assets and liabilities, and foreign exchange gains and losses on interest and other amounts equivalent to interest. So from this, you see that the term interest is not just limited to loan interest. Let's take a look now at what is meant by the net interest equivalent. So any company with debt will usually have an interest expense in their P&L. There are also scenarios in which companies will also have interest income. For these companies, the net interest equivalent is the interest expense less the interest income. So, for example, you can have a company with an interest expense of 7 million and interest income of 1 million. So this company's net interest equivalent would therefore be 6 million. So in terms of interest limitation rules, we are clear at this point on what constitutes the definition of interest and also what net interest equivalent means. So let's move on and take a further look at how these amounts could be restricted under the new rules. So what the ILR aims to do, as Angela's mentioned earlier on, is to limit the maximum tax deduction for net interest expense to 30% of tax EBITDA. EBITDA in the normal sense, as you probably all know, refers to earnings before tax, interest, depreciation, and amortization. However, the ILR refers to tax EBITDA, and that is different. So this is the tax measure of profits and not the accounting measure. So it's not possible to take a profit figure from the financial statements and adjust that because you won't arrive at the same figure as the tax adjusted EBITDA figure. So there's a specific formula in the Tax Act that sets out how to calculate tax EBITDA. And as you can see on the slide there, it's quite complex. So it's not necessary to get into the detail of that right now. But you'll see from that formula that it contains excuse me, what is called the relevant profit or loss. And the relevant profit or loss is a profit or loss subject to corporation tax, plus development land gains, less current year charges and losses, excuse me, but before carried forward or back losses and group relief. So that is the current year measure only that is taken into account. Any profits and gains then taxed at 25% or 33% need to be adjusted to arrive at the relevant profit or loss. And from this, then you exclude profits and losses on long-term infrastructure projects. Sonia will discuss these further later on. So what we'll do now is take a look at an example of how the interest limitation rules could work for a company. So in this example here, we have company A, and step one here in this process is to assess the interest equivalent in the period. So company A has an interest expense here of 8 million. All the figures here are in millions. An interest income of 3 million. That leaves them with a net interest equivalent of 5 million. Excuse me. So we're told in this example that the tax EBITDA here is 12 million. And, that just means that behind the scenes, the formula has been calculated. And the result of that is this 12 million that we have here. From that, then, we take 30% of the EBITDA to arrive at our restricted amount. And 30% of 12 there is the 3.6. So what we do then is compare the net interest equivalent to the allowable interest amount. Our net interest equivalent was 5, and we worked out that the allowable amount is 3.6. So in this scenario for company A, there's a restriction of 1.4 that needs to be applied. When we looked down at how that works into their tax liability, we see that they have a tax adjusted profits here of 15. We allow the 3.6 that's allowable under the new rules, and that leaves them with a tax liability of 1.43. So we have a computation here on the right-hand side of the slide that shows if the interest limitation rules were not in place, what the situation would be for company A. And we see that before the introduction of the rules, they would have had a deduction of the whole 5, and therefore their tax in that instance would have been 1.25 million. So company A is going to have an additional tax an additional corporation tax liability of 180,000 in the period because of the interest restriction. So in that example, we looked at Company A and how the interest limitation rules apply to Company A itself. But what if Company A was a member of a group? So the interest limitation rules apply to what's referred to in the legislation as a relevant entity for an accounting period. A relevant entity is a company, so that's a single entity like Company A, or an interest group. Therefore, the rules can be applied at either a single entity level or interest group level. So what is an interest group? An interest group comprises companies that are either A, consolidated for accounting purposes, or B, in a tax loss group, and in either case have elected to be in the interest group. Therefore, a company is not automatically in an interest group because of either A or B. It must also elect to be in the interest group. So if an election is made, it shall apply for a period of at least 3 years. After that period of 3 years has elapsed, an election may be withdrawn, but this withdrawal will then also apply for a period of at least 3 years. There is a 3 million de minimis limit that Sonia will talk to you about a little bit later. But please note that when you're electing into an interest group, this 3 million limit will apply to the whole interest group. So the advantage of electing to join the interest group is that the companies in the group have the potential to share interest capacity within the group. So we'll take a look now at another example, and this is Group AB. So in this instance, Company A has a net interest equivalent of 5, but Company B doesn't have an interest expense or interest income in the period. We're given their tax EBITDAs there. And even though Company B does not have an interest expense or a liability, 30% of its EBITDA can also be calculated in that instance. And we see here that Company B has an allowable amount of 2. When we work down to see where the restriction is for Company A, we see that they're going to have a restriction of 2. So in this instance, Company B can surrender its allowable amount of 2 to assist Company A with reducing its liability. So Company A has a restriction of 2, but Company B has an allowable amount of 2 that it will not be getting a deduction for, as it doesn't have interest in the period. So if in a group, Company A can get a deduction for the 2 million from Company B. Again, if we look at the table on the right-hand side, we see that Company A pays additional corporation tax of 250,000 in the period if it does not elect to be part of the interest group. So I hope this gives a little more detail as to how the interest limitation rules will apply in practice. I'll hand you over now to Sonia, who will take you through the exceptions to the interest limitation rules.
Hi, everyone. So I'm going to talk you through the exemptions and the relieving measures available within the new interest limitation regulations. The first one is a standalone entity. A standalone entity is a company in the state where they are not part of a worldwide group, have no associated enterprises or permanent establishments other than in the state. These entities are totally exempt from the interest limitation rules. Next, we have the 3 million de minimis exemption. The legislation allows where a company or interest group's net borrowing costs are less than 3 million for an accounting period of 12 months, then there will be no restriction on the deduction. If the accounting period is less than 12 months, then the amount is prorated for that shorter period. The full amount of interest expense is subject to the restriction, not just the excess if your interest expense is over 3 million. And remember, if you elect to be part of an interest group, only one 3 million de minimis applies to the group as a whole, and the election is for 3 years. Legacy debt is also excluded from the calculation. So if you entered into a facility agreement prior to the 17th of June 2016, and with the sole purpose of eliminating or reducing your interest rate risk, then the deductible interest equivalent on that legacy debt can be excluded from the deductible interest calculation. If there was a provision for an amount of the principal to be delivered after that date, the terms are legally binding and have agreed milestones, then these amounts can also be considered as legacy debt with no restrictions. There's also provision that states there must be no change to the agreement. If there is any modification to the agreement, then you may not get the full deduction on that deductible interest. Next, we have qualifying long-term infrastructure projects. A long-term infrastructure project is one which will provide, upgrade, operate or maintain a large-scale asset. For the project to qualify as exempt, the asset must be in a member state, the operator must be established in a tax resident in a member state, and the income and deductible interest must arise in a member state. Where the relevant entity carries on a qualifying project and other activities, then the income and expenses should be apportioned between the projects on a reasonable basis. A large-scale asset is defined in the legislation, and some of the projects on the list include not only PPP projects, but also transport, railways, roads, strategic housing developments and renewable energy projects can be included. There's also provision for the Minister to specify further assets. The project must be for a minimum of 10 years. And when you're determining your deductible interest, the amounts from any long-term infrastructure projects are excluded from calculations. There are a number of relieving measures that we have available also to use if you're not exempt. The first one of these is the group equity ratio, where a relevant entity's ratio of equity over total assets is greater than, equal to, or not less than 2 percentage points below the group's equity ratio, then there is no limit on the deductible interest allowable amount. For this calculation, the equity includes your share capital, share premium, and reserves as disclosed in the financial statements, which are prepared under GAAP or an alternative body of accounting standards. And the legislation lists a number of acceptable bodies of accounting standards. The equity amount can also include the amount the relevant entity owes to associated enterprises which give rise to deductible interest. However, if there is a scheme of arrangement between associated enterprises to increase this equity, then that amount would not be included. The relevant entity must make an election if they wish to apply this section. The next one is the group ratio. The group ratio is calculated as the group's exceeding borrowing costs over the group EBITDA. When a relevant entity is part of a group and the group ratio exceeds 30% of EBITDA, then the relevant entity can use this higher percentage to calculate their allowable amount. For example, if the group ratio was 35%, then the relevant entity could have an allowable amount of 35% of their EBITDA. A single company worldwide group. Ireland has also introduced rules for single company worldwide groups, which is otherwise known as a group of one. This is a company that is not a member of a worldwide group, not a member of an interest group, and not a standalone entity. The group ratio and equity ratio I just discussed can also be applied in a group of one scenario. However, in calculating the group ratios under each of the measures, transactions with associated enterprises needs to be adjusted for. And lastly, we have carry forward restricted interest and interest spare capacity. So where a relevant entity has interest expense which was disallowed, then it can make a claim to deduct that amount from the following accounting period's total profits or chargeable gains. Or if that disallowed amount would have created a loss, it can utilise this as a loss in future accounting periods. There's no time limit on this loss carried forward. Furthermore, where a relevant entity has total spare capacity, then it can also carry this forward to be utilised in future periods. However, total spare capacity can only be carried forward for 60 months from the end of the accounting period in which the total spare capacity arose. Your total spare capacity is the sum of your interest spare capacity and your limitation spare capacity. Interest spare capacity is when interest income is greater than interest expense. And limitation spare capacity is when your exceeding borrowing costs are less than 30% of EBITDA. With the availability of these carry forward amounts, the restriction on the interest deductibility is in reality only a timing issue. I will now hand over to Angela, who's going to wrap up.
Thanks very much, Sonia, for that overview of the exemptions and the relieving measures. As I think we may now all appreciate, these rules are really complex, but there's also some opportunities in there to minimise the impact of the rules in limiting interest deductions. So I think in particular, there's a couple of things that occur to me. So I think, first of all, in group scenarios, the ability to choose whether to apply the rules at a single entity level or at a group level gives like really good flexibility to businesses to decide what works best for them. And this will be different from one business to the next. And we also need to bear in mind that kind of 3-year rule for elections into groups. So if you are making that decision as to whether to opt into a group or not, really you need to look at that decision over the kind of medium term, rather than just looking at it on a kind of year-to-year basis. The other thing I find really interesting is the definition of long-term infrastructure project. The definition in the BEPS action plan is a lot narrower than what it is in the ATAD. And effectively, BEPS try to kind of limit that exemption to PPP type arrangements. So ones where there's some level of state involvement. But what you would have seen from the list that Sonia showed there, the definition that Ireland has brought in is a lot wider than that. And that's actually something that in BDO we advocated for in our responses in the consultation process. So I think we're all really aware of the investments that need to be made in Ireland in areas such as housing is a really good example. And without that wider exemption that we have now, there was a risk that bringing in these interest limitation rules could have actually impacted on the feasibility of those types of capital projects. And that really would have had a significant detrimental effect for Ireland. I think it's probably also worth mentioning at this stage that at the moment, all we have is legislation. So Irish tax law is typically supported by revenue guidance. And this guidance is then instrumental really in giving clarity on matters that the legislation might leave some doubt about. So what is happening at the moment is that there is ongoing engagement between tax advisors and their representative bodies with revenue in order to identify areas in which revenue guidance is required or would be helpful. And in BDO, we're also involved in those discussions as well. At this stage, we've kind of given the presentation, but what I'd like to do now is hand over to the audience for any questions. And we've got a couple of questions have come in there. So I'm going to start going through those. So first question here, Sonia, I'm going to come to you on this one. Long-term infrastructure projects are excluded from relevant profit. Would a wind farm qualify as such long-term infrastructure project?
No, I think wind farms are specifically excluded from the long-term infrastructure project, so they would not be able to be included in the exemption there.
Yeah, I think, as I said, I think that wide definition is really helpful. I think what is important, if you're considering whether the exclusion might apply or not, the legislation brings in a lot of references non-tax legislation. So it's mostly kind of planning type regulations. So what you do need to do if you think that you have a project that might fall into this is have a look at the actual Planning Act section that's referenced within the tax law and make sure that they are aligned and that you do kind of fully fall into that exemption. So another question here, really good question. What if I have losses in the year? Is all interest then restricted? So who wants to take that? Sonia, do you want to take that one as well?
Yeah, I can take that one, Angela. So if you have losses in the year, then you're not going to be paying any tax anyway on because you will not have profits as well for it. So in that case, your restricted interest, or rather your interest that is not used, can be used you can make a claim to make this a loss, and that loss can then be used as any other loss and carried forward to future periods, can also be carried back.
Great, thanks. So what else do we have? So, okay, the long one in here. Given that there is an unlimited term for unutilized interest to be carried forward, as you say, this is really just a change to the pattern of tax payments rather than a change to the ultimate amount of tax a company will pay and therefore the exchequer collect. Therefore, what ultimately is the aim of this rule from a BEPS point of view, given it doesn't change the ultimate amount of tax revenues a jurisdiction collects? Great question. I might take that one. I think, Sonia alluded already to this being kind of more of a timing issue because you do have those carry forward provisions. be that as it may, it obviously has a tax cash flow impact, and you've absolutely picked up on that in your question there. But I think fundamentally what we'll probably see happening, and actually what we have already seen happening, is changes in terms of kind of financing structures. So how far you maybe push the limit in terms of debt loading in an entity, or how far you push the boundaries in terms of you've done your transfer pricing analysis. Do you go with the interest at the higher end of the scale, or actually do you go with much more supportable level of interest rate on your debt? That would be much easier kind of to defend with revenue. There's also, I think, some scenarios maybe in a SPV type scenario where while it might be seen as a timing difference because it gets carried forward, that actually if you do your modeling, I suppose, over the lifespan of the asset and lifespan of the SPV, that maybe you might actually find that there's an element in there of permanently deductible or permanently disallowable interest. So I think may not always be the case that it's just purely a tax deferral. Hopefully that answered your question. I saw a question there on interest groups. So here's one. Why would a group opt to apply the rules on a group basis and not just do it on an entity by entity basis if the 3 million de minimis is available to each company? Yvonne, I go to you on that one.
Yeah, so I think really to answer this question, like we said earlier, it will depend on the group itself or the company itself. So if it's a group that is kind of meeting this 3 million on an entity basis, you'd have to kind of take a step back at that point and see how this is going to apply across the board in the group. One of the reasons that a group, or a company, in fact, might opt into the group is for a reason like what we saw there in the example, where a company in the group might have interest spare capacity that it can surrender across to other companies in the group, and that they can then utilize that capacity in their returns and therefore claim the deduction and reduce their tax. So in that instance, that would be an instance in which opting into the group would be advantageous for the company. If you have a group of 3 or 4 companies and they're all at a level of in and around the de minimis amount, obviously opting into the group and having a 3 million de minimis across the group is not going to help a company in that situation.
Thanks very much, Yvonne. I think another scenario that we would have spoken about, which is kind of very probably nuanced to Ireland, is the concept of 247 groups. And typically how they're structured is you've got one entity in the group with debt and nothing else, which it's group relieving around. And unless you make that group election for the interest limitation rules, you effectively have 100% restriction in that entity. And if it has no other taxable income, it's not really a deferral either. In that instance, it becomes then more of a permanent disallowable. So that is that's something in Ireland, I think, that's going to be kind of quite relevant for us. Okay, another question, Sonia, I come to you on this one. What if my company has €3,001,000 of interest expense? Is it just the €1 that's subject to the limitation or the full amount? This is obviously getting at the 3 million de minimis.
No, unfortunately, the legislation does not have anything in there for marginal relief on the 3 million de minimis rule. So if you have €3,001,000, then the full interest amount is applicable for the restriction and not just the €1. So you're caught that way, I'm afraid.
Yeah, it's a bit of a cliff edge. All right. Okay. Sonia, I think this one for you as well. What if my group ratio is below 30%? Am I limited to the lower ratio?
No, so the group ratio is a relieving measure that you can use, and it's not something that you have to use. So if your group ratio is below 30%, then you can avail of the 30% of EBITDA for yourself, and you don't have to go with what the group ratio is. So it's a relief measure that you can take, but you don't have to take it.
Thanks very much. Couple of questions in here about take this one. Are lessors severely impacted by this legislation? Are Section 110 entities okay due to the net interest aspect? So this is obviously quite relevant to us in the financial services space. So I'll take the second part of that first. Section 110 entities okay due to the net interest aspect. I think it is absolutely helpful that you net your interest expense against your interest income on a euro for euro basis, and it's only to the extent that you have a net interest expense that's the level that the limitation is applied at. So I think there'll be, a good few Section 110 companies who might be okay on that basis. There are some Section 110 companies though that maybe might not have a kind of very clear interest expense or interest income in, say, their financial statements. Now, we have seen that the definition of interest is broader, and I think it's probably worth just reiterating that that broad definition of interest applies both in the context of interest expense and interest income. So I think in that respect, even if you have something in a Section 110 company that mightn't be classified as interest in the financial statements, or may not be, interest in the classical sense, it may still fall within that definition, that wider definition of interest. There's also a really interesting one. It was at the end of that list that Yvonne showed you, and that's anything else that's kind of economically equivalent to interest. So that's something that needs to be decided on a case-by-case basis, and I think that's going to be quite relevant to Section 110 companies who maybe have something other than interest income in their financials. The first part of the question there, lessors severely impacted by the legislation. So there was, quite a lot of discussion in particularly the aircraft leasing industry on the impact of these new rules. Similar to when you're discussing things like property or other kind of capital intensive industries, it is pretty standard to see fairly high levels of gearing in the leasing industry. So obviously any limitation on how much interest you can deduct is a big issue for the industry. But I think there's a couple of key things in there. First of all, that whole net interest issue that I just spoke about there. So the ability to net off your expense against your income on a euro for euro basis, that should give some relief, I suppose. There is also in the definition of interest, full stop, it includes the finance element of operating lease income for trading lessors only. So that is something really that has been brought in, very much targeted at the aircraft leasing industry, because predominantly leases are operating leases. So that allows you to extract a portion of your operating lease income, the finance element of it, apply your interest expense on a euro for euro basis, and then it's just that net interest expense that you're then limiting. And then I think the final thing to note on that is that your limitation is, remember, it's an EBITDA, so it's before your depreciation, amortization, etc. So obviously capital allowances are a big thing in terms of the aircraft leasing industry. So your limitation is on a higher measure of earnings and not after your capital allowances. So there's a good few things in there that kind of, I think, might give a better answer after you've worked through the legislation and how it actually operates than maybe it might look on the face of it. Okay. A question here on legacy debt. Sonia, I might give this to you. So it says, if legacy debt pre 17 June 2016 was restructured after that date, which is the date deemed to be the starting date of the loan, restructured date, or original loan date?
So if it's restructured, then the legacy debt, you need to take a look at the amount of interest expense that would be on the facility agreement before the 17th of June, and then what it's restructured, the restructured amount of legacy debt interest would be. And you take the lower of the two amounts. So if it is restructured, you're not allowed increase your amount of your interest expense that would be allowable, or you're not allowed to exclude a higher amount than would have been on the original agreement.
Thanks, Sonia. Sorry, there's another one there I was going to ask. Okay, for you, Yvonne, can you have, say, half the Irish group opting into an interest group and the other entities staying out of the interest group? Good question.
Yeah, that's quite a good question. And yes, absolutely. So long as the companies are chargeable to tax in Ireland, and that they meet the criteria that we discussed earlier on. So that is that they're part of an accounting consolidation group or a tax loss group. And then after that, of course, they'll have to elect into the interest group. Now, just also to bear in mind on that, like we did mention, you want to look at this in terms of the medium term as the 3-year election applies. So anybody that elects in will be in the group for the 3 years, and similarly, anyone that elects out will be out for the 3 years. So there could be an exercise required there just to determine, kind of what will result in the best kind of tax outcome for the group.
Thanks, Yvonne, for that. Yeah, I think we were speaking with our UK colleagues on this recently, and they were surprised in terms of that kind of group election that we have in Ireland. So I think that is something that's actually very favourable and should give good opportunities to be able to kind of manage the impact of these for groups. The next question here: are interest groups for Irish tax resident companies only? I might take that one. So Irish tax resident companies only. So if you have non-Irish tax resident entities, that aren't in scope of Irish corporation tax, well then they're outside of this, maybe in the rules for other jurisdictions, etc. If though you have, say, non-Irish tax resident entities, but they are within the Irish tax net in relation to certain types of income, well then they are within corporation tax and therefore within these rules. So I think, one of the things that happened over the last couple of months in our finance bill that introduced these rules also made a big change to non-resident landlords. So previous to our latest Finance Act, non-resident corporate landlord was within the charge to income tax on their rental income and not corporation tax. So without a legislative change, those entities would have been outside of these rules, because these rules apply to profits subject to corporation tax. So that changed in the latest Finance Act, and those companies, albeit they're not Irish tax resident, are now subject to corporation tax on their rental profits, and therefore they are now caught by these rules. But also, within all the various exemptions and ratios and all of that kind of thing that we spoke about here as well. Okay, based on my accounts, I have less than 30% debt funding. On that basis, can I just treat all interest as allowable? Who would like to take this? Yvonne, maybe?
Yeah, sure. No, sadly, it's not that simple. Like we said, it's not an accounting measure that's applied when we look at the limitation. It's a tax measure of profits. So, like we mentioned, there is quite a complex formula, and out of that, certain amounts stripped out in terms of what's there for capital allowances, what's there for long-term infrastructure projects, legacy debt, etc., etc. And then and then the 30% is applied then at that stage. So no, it's not as simple as that.
If only. I think is the answer. Yeah, look, the rules are complex, and I think, you know, there might be plenty of scenarios where on the face of it you think you're okay and turns out you're not, and vice versa. Ones where you think it's going to have a big impact, but when you get into the weeds of it, because of various exemptions, relieving measures, etc., that you might actually be okay. I'm just conscious of the time. We want to finish at 1:45. So I think, you know, at this stage, we're just going to start to wrap up. I do want to thank everyone for their questions. There's loads of questions coming in there, and unfortunately I didn't get to all of the questions, but if there is anything else that you would like to get some clarity on, please do contact us, get in contact, and we can deal with that. We've also had really high attendance at the session and great levels of engagement, you know, we've seen there in terms of the questions. And I think that's really represents the fact that people kind of get that these rules are really relevant to a lot of businesses. I mean, we're talking all businesses with borrowings, and really that is the vast majority of businesses. So this is something that we all need to be really, really mindful of. I hope, I'm going to wrap up now. So look, I hope that you found the webinar today useful, both in kind of better understanding the rules and also kind of whether and to what extent that they could have an impact for your business. I'm going to leave you with one takeaway, and that's to take action now. So these rules might be effective from the 1st of January 22, and, you know, first tax returns due for filing in September 2023, but don't leave it until then to figure out what effect or impact these new rules might have. We're encouraging all of our clients to start assessing the likely impact of the new rules, and start doing modelling exercises, see what exemptions or relieving measures might apply, how you can minimise the impact, any restructuring that's needed in terms of kind of financing arrangements, transfer pricing arrangements, all of that stuff. That takes some time to work through, and it's not something that you want to be trying to get the head around, you know, if you've only got a couple of months towards a tax return filing. So I'm going to leave it there. On behalf of Sonia, Yvonne and myself, thank you everybody for your time and attention this afternoon. I hope that you find the session helpful. And again, please do get in contact with us if you'd like to discuss further these new rules and how they impact your business. Thank you again, and enjoy the rest of your day.